Dear clients, welcome to PhillipCapital's weekly market watch. I'm Colin, Analyst from Phillip Securities Research. Today, I'll share with you on the Singapore banking sector. The Singapore banking sector has produced good sets of results thus far for FY13 despite challenging macro conditions for the past 3 quarters. We remain overweight on the Singapore banking sector and expect a positive road ahead with DBS Group Holdings Limited remaining our top pick for the sector. With the US Fed announcing the decision of QE tapering in December 2013, long-term interest rates have started to move up further. Net interest margins for the sector are at their historic lows, but the Singapore banking sector has managed to stabilize net interest margins and increasing net interest income by growing their loan books healthily. We expect the interest rate cycle to revive in the medium term as the US Fed is still maintaining a low interest rate environment currently. Once short-term interest rates move, we expect the recovery of net interest margins and a boost to the earnings of the banks. The banks have been growing their loan books at a healthy momentum thus far, and we expect them to meet their guidance of mid-teen growth for FY13. The banks have guided for high single-digit growth for FY14. Although housing loans is expected to decrease from second half 2014 onwards as mortgage originations have fallen about 30% so far, we expect the banks to be able to meet the moderate loans growth target because of improving macroeconomic conditions. Loans typically track the Singapore GDP growth, and with our positive outlook on Singapore's GDP growth, we expect this to support the banking sector loans growth together with them actively seeking overseas loans growth. DBS Group's holding remains our top pick for the sector, and our new target price is $19.09. There are 4 key investment merits for DBS that makes us prefer DBS over its peers. First, DBS is positioned to benefit the most from rising interest rates. It has the strongest current account savings account, the total deposit ratio, and most liquid SGD balance sheet, meaning that cost of funding can remain cheaper than its peers. Second, DBS has the most exposure to Greater China through its presence in Hong Kong. As we are positive on China's economy in the medium term, DBS is again better positioned than its peers. Third, DBS has been trading at a discount to its peers with a lower price-to-book ratio of 1.29, making its valuation undemanding. Lastly, it still has an attractive and stable dividend yield of 3.3%. Therefore, DBS Group Holdings remains our top pick for the banking sector. Look forward to Friday's weekly market watch, where the commentator will be covering CFD market outlook. We want to hear from you. Any questions, any comments on Friday's topic, please drop them via Facebook and Twitter, #TalkToPhillip. Thank you for watching this week's Market Watch. I'm Colin from Phillip Securities Research. Tune in next week for more Market Watch videos.